Money laundering methods. Money laundering is a real risk for many companies, as organizations today find unimaginable ways to introduce illicit funds into the financial market. To ensure that the organization complies with all the regulation to which it is subject, it is important for the compliance department to be well versed in the types of money laundering that exist. Number 1. Smurfing. Smurfing is one of the most well-known forms of money laundering. It involves diversifying money from illegal activities to carry out numerous transactions of smaller amounts without raising suspicion. Because the amounts are small, they are very difficult to trace, and these types of transactions quickly become undetected. All it takes is recruiting volunteers in disadvantaged economic sectors seeking to entice young people or the unemployed to provide their information to open bank accounts and financial institutions where the requirements are minimal. Currently, opening digital bank accounts through a financial institution website where data is not securely validated and there's no physical contact required to complete any predetermined questionnaire creates a criminal opportunity for organizations dedicated to this crime. For example, there was a massive case of saving accounts opening by a group of Colombian clients who reside in Peru. They had all declared the same property as their address, arguing that they were fleeing their country due to the lack of security and the institution never verified their address. All of them had their passport as their only identification. These were never validated since there are no direct communication channels with the government entities. Shortly after, they began collecting debit cards linked to saving accounts opened by very young people whose declared economic activity was that of students or self-employed traders, without providing any proof of this. Furthermore, the accounts were opened without any type of control. Consequently, the small group of accounts initially opened multiplied exponentially over the course of 5 months. The statistics generated show that all the money entering Peru was withdrawn from ATMs located in Colombia, totaling astronomical amounts. The curious thing was that these withdrawals came from debit cards issued to Colombians who collect them with a simple power of attorney, once a week and simultaneously across all accounts. Number 2. Hawala. Hawala is a network used to launder assets without leaving a documentary trail. This system is based on connections between people from different countries built on mutual trust. This type of money transfer originated in the 8th century as a method to settle debts between friends and family in South Asia. Currently, Hawala works like this. The sender and recipient use intermediaries in their respective countries. Typically, the money is handed over to the first intermediary, who then provides a code that the recipient can use to obtain payment. According to United Nations reports, in Afghanistan, which supplied 80% of the war opium, individuals within the Hawala network, better known as Hawaladars, may directly involve in transferring payment to opium growers or consumers, or may assist in transferring drug trafficking profits between countries. Organized crime groups also use the Hawala system as trusted or intermediaries between drug sellers and buyers. Let's look at a real-world example: migration. Many migrants and refugees often turn to Hawala due to its accessibility and the lack of alternative financial systems, such as banks or mobile money services. Hawaladars help these people not only with money transfer but also with finding work, accessing temporary accommodation, and connecting them with essential services during their journeys. Essentially, Like opioid traffickers, Hawaladors act as trustees between the migrant smuggler and the migrant and refugee before the journey begins. The Hawaladar will hold the migrant's payments in trust and transfer them to the smuggler only after the migrant has confirmed arrival at the agreed destination. Number 3. Real estate acquisition and construction. The purchase, restoration, or construction of real estate is one of the most common forms of money laundering due to its rapid efficiency. Individuals can legalize the proceeds from these transactions, justifying that their income comes from sale or rentals. Both financial and real estate companies must be vigilant against this type of money laundering, as it not only poses a significant challenge to law enforcement agencies, but also undermines the stability of the real estate market itself. It allows criminals to inject illicit funds into the legitimate economy, distorting property price and potentially impacting the broader financial system. This is a global phenomenon, primarily affecting homes and buildings, but any form of real estate can be used for this purpose, for example, vineyards. Possible indicators for detecting money laundering schemes in the real estate sector include the following: geographic characteristics such as distance between the property and the buyer and their actual geographic center of interest, discrepancy between the typical income and wealth of the owner and the property. In some cases, the most expensive properties in the city are owned by people with no income or wealth that will allow them to purchase the property. An anonymous owner, as a result of recourse to a third party or to companies, trusts, or similar arrangements. 4. Creation of shell companies. A shell company can be defined as a non-operating business, that is, a legal entity that has no independent operation, significant assets, ongoing business activities, or employees. Typically, a professional intermediary offers to shell company to a corrupt party, who then use it to hide the money trail by transferring illicit funds to and from the company bank accounts. These types of companies or corporations are created to demonstrate income from their products or services, but in reality, they are not engaged in any activity, and the profits come from illicit sources. This is a very common way to reintroduce currency into the economic market. They are typically formed in jurisdictions known as tax havens, and their primary or sole purpose is to insulate the true beneficial owner from taxation, disclosure, or both. Shell companies are also known by several other names, including international trading companies, personal investment companies, and front companies. Transpa International Endowment, a global movement working over 100 countries to end the injustice of corruptions, believe that governments should establish mandatory public registries that reveal the beneficial ownership of trust funds and companies or partnerships. Public registries of beneficial owners will make it easier to trace ill-gotten gains and make it more difficult and less attractive for individuals to benefit from the proceeds of corruption and crime. While not public information, some offshore jurisdictions are enhancing transparency by requiring registration of beneficial owner information in a register accessible only to competent authorities, like in the case of the UK Overseas Territories. This means that while the general public won't have access to this information, relevant government bodies can access it for a specific purpose like law enforcement or tax investigations. Some other examples are the Bahamas, the Register of Beneficial Ownership Act of 2018, in Panama, the Single Private System for the registration of final beneficiaries of legal entities, in Seychelles, the Beneficial Ownership Act of 2020, among others. Number 5. Foreign trade and fictitious exports of services. Another very common type of money laundering involves phantom sales of services, which is difficult to verify because their true value cannot be determined due to their intangible nature. Typically, a fictitious contract is signed between an accomplice in another country, simulating the export of a services. Once finalized, the invoice and payment are issued and the payment can be entered back into the financial system. Through foreign trade, the following mechanisms are used. Modification of the value of a commercial transaction on an invoice. Overbilling or underbilling, which may result from fraudulent information regarding the quantity, quality, unit price, and description of a good. Repeated billing for the same good and the same people who have arrived, which will generate double, triple, etc. billing. It is related to capital flight, tax evasion, value-added tax or VAT, incentive to export fraud, shipments of goods and services in larger or smaller volumes, as well as false descriptions of goods and services, and others. Number 6. Cash-intensive businesses or companies. Cash-intensive businesses are frequently exploited for money laundering due to their ability to process large volumes of cash through routine operations. They provide a convenient way to mix illicit funds with legitimate revenue by channeling dirty money through such businesses. It becomes significantly more challenging for authorities to trace the source and detect suspicious activities. Some of the most common examples are restaurants or bars, retail stores, liquor stores, cigarette distributors, privately owned ATMs, vending machine operators like food solution for organization, institution, or companies through an automatic distribution system, taxi companies, car wash station or machines, parking garage, among others. And number 6, cybercrimes. Cybercrime is another source of money laundering. This includes cyber attacks such as phishing, ransomware, credit card fraud, and identified theft, which allow cyber criminals to obtain large illicit profits. These profits are then laundered through digital means such as online transactions and the use of cryptocurrencies.